So plans to cut the ISA allowance down from £20,000 per tax year to something like £4,000 is probably not going to go ahead. And this is thanks partly to the outrage we have seen on YouTube and other online sources. A lot of people love their cash ISAs, and if Rachel Reeves decided to cut the cash ISA, I think that would have been a very unpopular choice. However, the problem is not sorted out because investment into UK companies is very bad, very poor, especially compared to US companies, which, a significant portion of US citizens do invest, as opposed to the UK, where a very small minority of people actually invest. So Rachel Reeves and the government still need to find new innovative ways to raise taxes without it looking like a new tax increase. The plans to cut the cash ISA allowance would have been a creative way to inject new money into UK companies, essentially also bringing in more tax revenue, as these companies have more to invest with and therefore could use that money. So now there are talks or plans to encourage savers to potentially take on investment products. And this, in my opinion, is a radical shift away from the whole capital at risk and being risk averse as a society in the UK. Now, is this a good idea? In today's video, I'm going to discuss this because going from saving to investing can be a massive jump, especially for people in the UK. So if you've watched any of my videos before, you would know that investment products beat out cash in any meaningful time period. We're talking about 10, 20, 30 years, and in some cases even a shorter period than that. Basically, if you are holding onto cash even in a good savings account, you aren't really beating inflation by much. And in real world terms, if you keep all of your money in cash savings, you are actually losing the value of the cash you have. Every year you can buy less and less products and services with the same amount of cash you have if it doesn't grow beyond inflation. So there is a crazy new plan to target these savers who might be on low interest rates and try to convince them to go into investment products instead. I personally created this YouTube channel almost 3 years ago to encourage more people in the UK to invest. And I feel like since then, the landscape has completely changed. A lot more people are investing as opposed to just saving. So how exactly will the government go about in trying to convince cash savers to go into something like stocks and shares? Well, until now, if you've ever seen an advert of anything to do with investing, you would have seen the words capital at risk being plastered all the way around. And this is an FCA requirement, and failure to do so could result in huge fines for the people creating those adverts or creating content. Now, obviously, when you are investing, your capital is at risk. However, there are ways to mitigate these risks and make them a lot smaller than what they can appear to be. Unfortunately, when it comes to investing, there are basically two types of investments, one which have a track record of proven history, something like the S&P 500. So we're talking about index funds where there is diversification. And the other realm is picking individual companies, which in my opinion is very high risk, because if you put all of your money into just one company and the company stagnates or it fails, then you can potentially lose all your money, or you could lose money and see it never recovering again. So the Treasury is thinking of ways in reforming the way that we look at risk associated with investing in the UK. Now, this could mean many things, maybe a change in wording of the whole capital at risk, or even educating people more about the risks associated with investing. Like I said, you can think of investing as two realms. One is the diversified investor, who over the long term really doesn't have to worry every day about the value of their initial investment going down. And then there's the risky investor who just looks at individual companies, maybe one or two companies. There's no diversification there. Those investors are also more likely to potentially be scammed, because in the stock market, unfortunately, there are companies that don't really do much but can easily be manipulated, and people can profit off of them, unfortunately. So in another article, Rachel Reeves is looking at wording around being negative about stocks and shares. If you ask anyone over the age of 40 in the UK about investing, they probably would say that they would never do it because it's too risky or it's too late. I feel like the UK needs a lot more education about investing. Sure, it does have its risks, but you can also reframe that and say not investing is also risky, because you also risk losing your savings to inflation. So here I have a trading 2-on-2 cash ISA, and essentially what this allows you to do is to save cash within an individual savings account account. So anything that you make in terms of interest is tax-free. A lot of people don't even realize that the interest that they are gaining on their bank accounts, that interest could be liable for you to be paying taxes. Now, within an individual savings account, none of this is taxable. However, like we said in the beginning, cash accounts aren't really the best suited to beat out inflation. Trading 212 typically has a very competitive interest rate, currently sitting at 4.1% as an annual equivalent rate. Now you can see that the current central bank interest rates, the Bank of England I should say, is 4.25%. So Trading 212 is giving very close to that. However, the concerning thing is that the current UK inflation rate is a massive 3.6%. So unless you are putting your cash into a bank account that pays over 3.6%, and just to be safe, a bit more than that because you don't want to be just leveling with inflation, well, unless you're doing that, you will be losing the purchasing power of your cash, which means you will be able to buy less and less. If you want to get started with Trading 212, whether it's just saving in cash or stocks and shares, you could get a free fractional share worth up to £100. All you have to do is to use the link in the description box down below. Alternatively, if you've already signed up to Trading 212 in the past 10 days but haven't received your free fractional share, all you have to do is to click the 3 horizontal line menu over here. Scroll all the way down until you see the section Use Promo Code. And in this section, just enter my code JUBAIR and you should receive a free fractional share. Now, when it comes to saving up for a house or things like that, you have to realize that the mortgage rates are always higher than the central rates. We're talking about 5.5%. So unless you are realistically earning more than 5.5% interest, well, you're going to find it very difficult to save up to pay for a mortgage, or even if you want to buy a house outright in cash, house price inflation is something you also have to account for. Now, in a similar vein, this is my Trading 212 Stocks and Shares ISA. Now, like I explained before, the ISA stands for Individual Savings Account, and anything earned in terms of interest, capital gains, and dividends paid out to me from my investments, those are tax-free no matter how large this portfolio grows. Now, I started investing in my ISA since 2021. Now, my total deposits in this ISA, including the ISA transfers, has been around £80,000. The rest has just been capital gains and dividends paid out. Now, in order for me to get a return on my money within a stocks and shares ISA, I will need to be invested into stocks and shares. Now, typically I invest into something like an all-world fund, which essentially includes stocks and shares from all around the world, so you have global diversification. The idea with investing is the more you are diversified, the less risk there is of losing your initial investment, although that could still happen. If I use the S&P 500 as an example, this is a fund that consists of over 500 companies that operate from the United States of America. This is by far one of the most popular funds that people invest in all over the world. And there is a reason as to why. As you can see, there are peaks and troughs, but overall the S&P 500 continues to grow. Now, this is where we have to be careful because although the S&P 500, we can go back over 100 years, has typically always grown, there is a risk that it might stop growing, or it might stop growing for a few decades. And a few decades is something that a lot of people cannot afford to miss out on. Now, here is a graph of the Japanese stock market, which was absolutely booming back in the 70s. However, towards the end of the 80s, something happened. The stock market peaked, and you would not believe it, it took decades for it to get back to that position. Now, this is surely a risk that could happen to the S&P 500. That is why it's important to understand what you are invested into. Now, in my opinion, the biggest risk when it comes to investing is not understanding what you are invested into. Now, if stocks and shares were pushed out to you, a lot of people, and I mean a lot of people, will gravitate towards individual stocks. Now, on Trading 212, for example, you can go into the top movers, which are stocks that have seen their value increase dramatically in a very short period of time. Now, for example, here is a company called Graphjet Technology. I'm not telling anyone to invest into here. Now, you can see how easily the narrative can be changed to manipulate people into investing into certain stock. You can see over the past week, this company is up by over 50%. However, if we look at the graph at a different axis, we can see that this company is dying. It is down by nearly 99% since starting. Now, this would mean that investors anywhere at the top would have lost 99% of their initial investment. And although towards the end of their life, there is a bit of a flopping fish effect where you see an increase, any investors that get into it at this point or before could lose absolutely all of their investments. Now, this is why it's very important to actually have education when it comes to investing. Over the long term, as you can see, my portfolio has always gone up, even though there have been ups and downs. This year in particular, my portfolio was less than £100,000, and today it stands at over £118,000. I'm a big proponent for investing into stocks and shares, as it has given historically a much better performance than cash. But the government definitely does need to do more in order to educate people about the risks of stocks and shares and the upsides of it. So make sure to check out some of my other videos, and I'll see you in the next video.